Thanks for joining us for our Fall Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me today are my colleagues, Dr. Nathan Thompson, who's an Assistant Professor of Ag Economics here at Purdue, as well as Michael Langemeyer, who's a Professor of Ag Economics here at Purdue and also Associate Director of the Center for Commercial Agriculture. Well, we're going to spend a little bit of time this afternoon reviewing the results of USDA's crop production report that came out this afternoon, as well as the updated world ag supply demand estimates from USDA. And it was an interesting set of reports, so let's take a look real quick. On the supply side for corn, USDA surprised most of us, I think, by reducing the planted acreage estimate by 1 million acres. That dropped it back to 91 million acres. Their harvested acreage estimate also came down 1 million acres to 82.5 million acres. And they had a very small reduction in yield. I think it was from 178.5 to 178.4 for the national yield estimate. And they also reduced the beginning stocks estimate, the carryover from the 2019 crop on September 1 by 258 million bushels. So that was a shock, I think, to most of us in terms of reducing the supply of corn that was going to be available here during the 2020 marketing year. And as you look at the corn production number, that put us at about 14.9 billion bushels. And you know, Michael, it wasn't too long ago that we had that slide up here and that showed a number that was very close to 16 billion bushels. Yes. So going back to last spring, we thought we might have a crop of almost 16 billion bushels. We're more than 1 billion bushels below that now. So the supply side has tightened up quite a bit compared to what we were talking about just a couple of 3 months ago. And really, if you look at that yield reduction and the decline in harvested acreage, that pulls down the 2020 corn production estimate by just this month, compared to a month ago, by 178 million bushels. If you look at it on the total corn supply side, of course, that differential compared to just a month ago is even bigger. It comes out to 436 million bushels when you combine the reduction and the carryover coming in from the 2019 crop. So that still gives us a larger corn supply than we had last year at 15.88 billion bushels. But actually puts us pretty close to where we were 2 years ago and 3 years ago, right? So, and coming in just a few months ago, we thought those numbers were going to be substantially larger. So it's a big shock, I think, in terms of corn supplies relative to what people were expecting, certainly back in July, and to some extent just a month ago. If you look at the corn yield estimates, they're kind of interesting. This is USDA's map of the state-by-state breakdown, and the small numbers underneath the yield estimate for each state are the percentage change relative to just a month ago. So here in Indiana, they pushed the yield estimate up, I think, 1.6%. Illinois down a little bit. Iowa down a little bit. So I guess if I was going to summarize it, the Eastern Corn Belt seemed like it fared pretty well. The Western Corn Belt, where we had more impact from the windstorm and more impact from dry weather, kind of pulled those yield numbers back a little bit. Michael, you've taken a look at this as well.
Yeah, it's also interesting to note that several states have record yields again. North Dakota, South Dakota, Minnesota, Wisconsin, Michigan, that northern fringe that had really good yields this year, as well as Indiana and Kentucky. I had a little hard time seeing that Kentucky number, but yeah, it had record yield too.
If you look at the USDA's corn production estimate, the national number, relative to what the industry was expecting, there's a number of different surveys around that try and estimate what people were expecting to see on the report. USDA came in near the low end of expectations and certainly below the average. So it was a surprise, I think, to certainly almost all of us, and maybe not everybody. But this reduction in yield was maybe not widely anticipated. That was a good way to put that. If you look at the demand side of the balance sheet, they reduced ethanol usage, their forecast for the upcoming year, down about 50 million bushels. They reduced the feed usage forecast by about 50 million bushels. No change in the export forecast. However, I think it's important to point out they were already, I think a month ago, they were at 32 or 33% above 2019, so 31% above 2019's exports, the revised number. So that's still a big number, right? A big resurgence in those export values.
And you were talking about that the ethanol demand last month seemed a little high, and so they did adjust it this month.
Yeah, and it's pretty clear on the ethanol side, we've kind of stagnated in terms of the recovery in ethanol usage in the domestic market. So that tightens up the ending stocks. Ending stocks as a percentage of usage coming in at 15%. A month ago, we were estimating that to be at 17% of usage. And I think, Michael, if you go back to July, I believe that was at 19%.
Yes, and we were
wasn't it?
talking about the possibility of being above 20%.
Yeah, so this is a pretty big change in a short span of time. And I think if you go back to the July report, if we had forecast this coming around in October, I think people would have questioned our wisdom.
Yes.
So it's a big shift. Now, when you look at it, that puts that usage as a percentage of ending stocks as a percentage of usage in the ballpark of where it's been in recent years. The big change here is the fact that we were expecting it to be so much larger coming into the marketing year. National average corn prices, USDA bumped it up again, 10 cents a bushel. A month ago they were forecasting a marketing year average of $3.50. Now they're at $3.60.
And it was $3.10 2 months ago, so that's increased dramatically in the last 2-3 months.
Yeah, so we're up 50 cents on their forecast for the marketing year average in just 2 months. That's a big swing in a short span of time. They did come up with the estimate for last year, which is $3.56, the 2019 marketing year, which is just a nickel below where it was for 2018. And actually 20 cents above where it was in both 16 and 17. So that's...
And it did trigger a PLC payment.
Yeah.
There's been a lot of news on that, 14 cents per bushel.
So, Nathan, you've taken a look at the relationship between prices today and prices that are available going out through the rest of the marketing year, and that's what this slide takes a look at. So walk us through that a little bit.
Yeah, so just kind of thinking about potential storage opportunities as we think about the 20 crop. And so what we're looking at here is the gold line is forward contract bids at a local elevator kind of in north central Indiana, west central Indiana, right there on the line, so in Delphi there. And so that's what they're currently bidding for delivery throughout the rest of the crop marketing year. And then the gray line is just kind of the current harvest price, so that $3.69 plus a on-farm storage cost of 1 cent per bushel per month that we're assuming, and then an opportunity cost on that grain that could have been sold here at harvest, carried through the storage season. And so the way we would basically interpret that is anywhere that forward contract bid is above the gray line, anywhere where the gold line is above the gray line, we would have a positive net return to storage. So the increase in basis from now until any point here in the storage season would be above what we assumed are the on-farm storage costs. And so you can see really the distance between that gold line and the gray line is really widest there in about January. And so you would kind of interpret that as that would probably be a point where we'd see some favorable return to storage, making a sale for January delivery. And that net return there is what, 16 cents above storage costs. So that's a pretty good return to storage there for corn.
Yeah, so that's kind of interesting. So just for some clarity here, if you look at that, the lower line, the gray line, the 369 out to the 392, one way to think of that is if your costs match what we've hypothesized here, which is the 1 cent per bushel per month, and we've assumed that you are borrowing money at about a 6% annual percentage rate, you'd be indifferent, right, between
Correct.
that 369 in October, November versus the 392 in July. On the other hand, if your costs are a little lower than that, maybe you're self-financed, so you don't have that 6% opportunity cost perhaps. There's always a debate as to what the on-farm storage cost per month is. One way to look at that is to say, and you could say that your cost estimates kind of provided a small positive return to that on-farm storage facility. So you might look at that a little more favorably, but clearly, you know, the advantage, and I think this is consistent with the historical work that you've done, that most years we see that relatively short-term pop.
Yep.
In basis, end of harvest, maybe the beginning of January, December timeframe, and that's showing up again, right?
Yeah, and it's here. And you know, again, these are forward contract bids, so these are locking in a price today for delivery at some point in the future. You could also think about a strategy where maybe you want to hedge some grain and put it in on-farm storage but not lock in basis. And again, at that point, you've kind of taken the futures price risk out of the equation, but have left basis open to speculation. And so if you have an expectation that basis is going to increase more than what these forward contract bids are giving you, that would be another strategy that would align. Based on the crop basis tool that we have on the Center for Commercial Agriculture's homepage, these bids are pretty well in line with what I would build as an expectation for basis kind of going through the storage season. And so, it would depend kind of on local conditions, or if you have a reason to think that there's going to be some favorable basis opportunities in the local market, then that might be another strategy that you could use to kind of take advantage of some of this.
Yeah, so that's a good point. So as you look at the futures market structure, that's kind of interesting as well. And you've taken a look at this both today as well as historically.
Yeah, so basically going back to the previous slide, the benefit that we get there is made up of two things, right? Any of those returns to storage comes from the futures carry, right? The spreads between futures prices and then the basis. And so here we're looking at kind of the futures spread component of that returns to storage. And so this is looking at corn futures for this afternoon. And so we can see kind of this very textbook stair-step pattern where basically the futures market is telling us that there's an incentive, giving us an incentive to store that grain. We'll pay you more in the future than we would today. And so, looking at it today from December out through July, we're looking at about 14 cents spread between those two futures contracts. We've done some work in the past looking at how those spreads change over time. And earlier in the marketing year, when we're doing some pre-harvest sales, we typically talk about hedging straight into that new crop December and waiting for that spread to widen as we get closer to the expiration of the December contract. Where we're at this point in the marketing year, I don't really expect that spread to widen much more than it already has, based on kind of the analysis of average seasonal changes in that spread. We probably, and again, it could widen, but I just wouldn't expect a whole lot more than what we have right now. So if you're, looking at a storage hedge strategy, selling straight into the deferred contract would probably be a relatively good decision.
Yeah, and so again, if you look at the chart, the biggest advantage would appear to be selling into the March at the moment, right?
Right.
And then trying to capitalize on the improvement in basis that occurs. So let's take a look at the basis tool, because that's kind of interesting. It's a kind of interesting story here with respect to basis, depending on where you're at in the Corn Belt.
That's right. So, looking at the basis side of those returns to storage, the blue line here, just for some background, is basically the 3-year historical average. And here we're looking at north central Indiana, just because that's where the forward contract prices that we showed you were from. And so just to kind of keep it consistent. And you can see that in north central Indiana specifically, the black line is kind of current basis levels, from the beginning of the crop marketing year, so September through now. They're running a little bit below that 3-year average. Not enough to really be notable, I don't think, but it certainly is a little bit below. But when you look around, that's not true everywhere, right? And so, we looked at some other locations. And I think that it's interesting to think about what is driving maybe those regional differences.
Well, let's talk about this north central situation. One of the things that's going on that chart is that average, the 3-year average, was boosted by the fact that we had very strong basis levels in north central Indiana last year.
Right.
And that was a function of the reduction in corn acreage that took place because of the planting problems, and also the fact that we had very strong ethanol demand during much of that corn marketing year until the pandemic hit.
Right.
So that gave us that strong basis level, and that's in turn we've turned that around this year, right? We've got very good corn yields, strong planted acreage, and weak ethanol demand. So that's really flip-flopped the basis situation in north central Indiana and eastern Indiana. So then let's take a look at another one. You took a look at this is for Illinois, near St. Louis.
Yeah. So we kind of the way the tool is set up, you can kind of look across different regions and kind of try to, understand a little bit of why those regional differences happen. And so it's kind of an interesting exercise to do. And so you and I were kind of talking about it. And, we can see, western Illinois, or I think we're in west-southwest Illinois, but kind of near the St. Louis market there, we see, the black line, which is that current year's basis, being quite a bit stronger than the 3-year average. And so, like you talked about, we kind of have this flip where we had relatively strong basis in the eastern Corn Belt last year. A lot of it had to do with planting issues and then strong ethanol demand. And we've kind of speculated a little bit here, this kind of flip where now we have this strength in basis further west is really probably, at least somewhat driven by export demand, right?
Yeah, as we looked at it earlier today, it certainly looks like as you get closer to the river, which is the export market, you start to see the stronger basis levels.
Right.
In fact, in Illinois, we didn't put additional charts in, but as you start heading east in Illinois, coming back from the Mississippi River, the basis levels start to erode. For example, central Illinois was still stronger than the 3-year average. Eastern Illinois, I think, was pretty close to what we showed for Indiana. So it's really flip-flopped the situation. Last year, we were really helped in the Eastern Corn Belt by an extraordinarily strong basis levels. The Western Corn Belt, not so much. This year, we're kind of, and the goal of basis in that environment was to try and encourage corn to move from west to east, because we needed it in the east. We've got the opposite situation this year, right? We're probably going to see basis levels trying to pull corn from east towards the west as we look at this different marketing situation. And so that creates some different marketing opportunities for folks. And I think it just highlights the importance of knowing your local basis level and paying attention to what's taking place in your area. The basis tool is pretty handy in terms of giving you these regional estimates, but then it's important to look at the individual markets that you actually sell at, right?
Yeah, for sure. We always recommend using this as kind of a starting point to kind of get that regional average, that regional trend, and then drilling down and making some calls to some local buyers there to kind of get an even better feel. Because again, this is an average, and so there's going to be some that are above and below even what we're showing here.
Yeah, and so we built the tool, and actually you're the guy that really built the tool. So Nathan every Friday updates the basis tool with new information. It's based on Wednesday cash and futures price closes, so it's weekly averages based on those Wednesday prices. And you update it every Friday morning, so it's a great thing to look at Friday afternoon or over the weekend and just kind of monitor what's going on, right?
Yeah.
And see what the basis level and basis changes have been over time. So, and we've got the corn charts up. We'll show some soybean charts a little bit later. So let's talk a little bit about what USDA gave us on the soybean side today. So they reduced planted acreage on soybeans as well, down about 700,000 acres to 83.1 million acres. And the same kind of reduction in the harvested acreage, so that brought it back to 82.3 million acres. They reduced the beginning stocks, the carryover from the 2019 crop, by 52 million bushels. Unlike corn, no change in the U.S. yield estimate, but when you put the acreage reduction and the smaller 2019 crop carryover, that together, that did really tighten supplies. And so if you look at total supplies of soybeans available in the U.S., we're at 4.81 billion bushels. That is larger than last year, but of course last year is the anomaly. If you compare it to 2 years ago, we're slightly below that. And then as you look at it from a state-by-state basis, and again, I think, Michael, you took a closer look at this.
Yeah, again, the northern regions, with the exception of North Dakota, have some pretty strong soybean yields, and there is some records in Minnesota, Wisconsin, Indiana, as well as some other states.
Yeah, it's kind of interesting to me as you look at Iowa went up and Illinois came down.
Yes.
Those two basically kind of balanced each other
Indiana
out.
stayed the same, as this chart indicates.
If you look at USDA's estimate compared to industry expectations, not so much like the corn, maybe a little bit below the average, but actually within the range of people's expectations, I guess, in terms of the production side. So no big surprise there. On the demand side, they projected an additional 75 million bushels in exports, and I think that was the number most people were trying to guesstimate before the report because of all the news coming out of China with respect to additional purchases.
Before we get to the stocks to use, we've got supply going down and demand going up.
Yeah, that kind of tightens things up.
That kind of tells us what's happening to the stocks to use.
There was no change in the domestic crush estimate, but the big story was really the reduction in supply with that small boost in exports. So then you look at the soybean ending stocks as a percentage of usage, and I guess I'd have to say if there's one chart in today's presentation that was a little bit of a surprise, particularly when you think about where we were just a couple of months ago, it's this one. Yeah. Right? Ending stocks as a percentage of usage for the 2020 marketing year projected to be 6%, down from 23% 2 years ago, down from 13% a year ago. And actually, in just the last few months, we've come down dramatically. I think 6% this month versus a 10% estimate in September. And of course, we were even larger than that back in July. So, in fact, I think, Michael, on a previous webinar, we talked about the fact that in a year when you would see soybean prices have a bit of a pop to them, it's in a year when ending stocks as a percentage of usage fall below 10%.
Yes.
And we didn't think we'd see it. But we're looking at it now, right?
Yeah.
So this is a dramatic turnaround, and it explains the strength in soybean prices that we've seen recently, as well as today following the release of the reports. So very, very interesting. You look at the marketing year forecast from USDA, 980, and that was up 55 cents compared to September's forecast. And the September forecast, Michael, I forgot to double check, but I believe
it was more than 55 cents.
Yeah, I believe it was up dramatically.
Yeah, so we're like $1.10, $1.20, if not more, in 2 months.
Yeah, it's more than that, I believe.
Yeah.
But anyway, it's a dramatic turnaround in terms of that marketing year forecast. So it's a huge change in prices. And again, Nathan, you've taken a look at the futures prices, and boy, those bids for soybeans look pretty attractive.
They do, and they look attractive for delivery now, right?
Yeah.
And so the story here is similar, but the interpretation or the information is similar. The story is completely different, right? And so again, the gold line represents current forward contract bids, for delivery throughout the storage season. And the gray line is again kind of this representation of the harvest price plus some assumed storage and opportunity cost. And so obviously that kind of increases linearly throughout the storage season. But what we see is that unlike corn, that soybean, that gold bar is below, right? And so essentially those forward contract bids don't even cover harvest price plus storage costs and opportunity costs. And so really, storing here, into the end of the year is basically a net zero, no returns above what we would expect to see, and then after that we see it kind of drop off. And so again, from the perspective of forward contracting, doesn't look like there's a ton of incentive to be locking in these prices for delivery in the new year at this point. And again, that doesn't mean there's no incentive to store. There could be opportunities for storage returns if you were potentially hedging. But like we've said, at that point, the futures market is not telling us at all either. We'll look at that in a second, that there's an incentive there. And so really you'd be storing on hedge, speculating on futures and basis if you were wanting to look at some storage returns on soybeans this year.
The market is screaming at you to sell some today, right?
It is. I mean, I think that's 100% the story. And we always talk about portfolios of marketing strategies, and we've done workshops where we talk about on-hedge soybeans as a part of that, and there's historical evidence to show why that might be a profitable part of a portfolio. But in this year, I would say it's a relatively small portion of the portfolio. The market is telling you it wants the grain now, and there's certainly profit to be made at those levels.
Yeah, let's just look at the futures structure, because I think this really tells the story, doesn't it?
Yeah, this really here just drives home, again, this underlies the previous chart. So why was that gold bar below the gold line below the gray line? And it's because basically the futures prices out into the future in those deferred months are lower than they are now. So we call this an inverted futures market, where the current nearby contract is trading higher than all of the deferred contracts in this crop marketing year. And so we see a big drop there from January to March. We were talking about kind of the level of inversion there and how that compares to some historical market inversions. We looked at 2012, I think, and so it was quite a bit more extreme. But nonetheless, the market is telling us, there's not a lot of incentive right now. It's not telling us to really store some grain.
Yeah, so let's talk about that a little bit. So you see inverted markets in years when you have short crops or short supplies. So the market is suggesting we are in a tight or short supply situation, despite the fact we've got some pretty good yields out there, which is kind of interesting. You looked at 2012. We were talking about that before the webinar started. That was the last time we saw a major inversion like this. And the inversion in 2012 was much more severe than what we're showing today, right? You looked at those numbers.
I want to say it was 91 cents relative to what we're looking at here. That's maybe in the ballpark of 20 to 25 cents, depending on which contract you're comparing.
So it's not the same kind of situation as 2012. The other thing that was interesting following the release of the reports today was part of that inversion went away. Yeah, that was kind of interesting.
It did, yeah. It kind of crunched those down a little bit relative to, so these were from this afternoon, and so yesterday or even early this morning it was a little bit wider, and so yeah, it was interesting to see that inversion kind of go away a little bit. I mean, it's still pretty strong signal. It's
a strong signal, but it was interesting to see that change. And I guess as you think about your soybean strategy, because one of the interesting things about the research that you did on marketing strategies was the notion that year in and year out, it was pretty clear in your study that devoting a portion of your marketing portfolio to unhedged, unpriced soybean storage was a profitable thing to do, right? And one of the things we talk about in those workshops is using the information you have available in the fall to help guide that decision. Is this a year when you want to do it? And we kind of think this is a year when maybe if you devote any of your portfolio to the unhedged, unpriced soybean strategy, it should be a small portion.
Yeah, I think that's exactly how I would put it. Because again, if the market is screaming for soybeans now, there may be an opportunity in the future for somebody to sell soybeans at a pretty favorable price, a pretty favorable basis. But again, there's a lot of uncertainty between now and then. You're speculating both on futures and basis. And so, I think that the major signal here is that if you can make money on these prices, the market wants you to sell the grain now.
And the terminology I like to use there is downside risk. There's a lot of downside risk to holding on to soybeans.
Yeah, I guess the other, what I thought you were going to say, Michael, was the fact that based on your budgets, these are profitable prices.
Oh, definitely. We have economic profit for soybeans as large as it's been since 13.
Yeah, so that's a consideration as well, an opportunity to certainly price some soybeans at some profitable levels. You've looked at the basis, using the basis tool for soybeans. It's a little different story than corn.
Yeah, it's a little bit different. So soybean basis has kind of, obviously going back to last year, we had, like we mentioned, strong basis levels on both corn and soybeans. And that has kind of persisted pretty consistently for soybeans, where we've got basis, 20, 30 cents above kind of average levels. And that's relatively consistent. I encourage folks to kind of check their local market. But when we look around, we see that being pretty consistent, unlike the corn, where we saw that pretty big swing depending on where you went from east to west.
So as you look at the basis running well above the 3-year average, I guess actually you've got a 2-year average on the screen, but you're well above that 2-year average. If you were going to forecast basis levels, for example, towards the end of the storage season, whether if you kind of that mid to late spring time frame, perhaps, based on your work, you'd probably come back to using the average as your forecast, right?
Yeah, so the research that we did kind of looked at these kind of horizon effects. So how far out into the future are we talking about forecasting? And so if we were forecasting in, say, through the end of the year, November, December, 8, 12 weeks into the future, we would say that current, premium above the average that we see would probably persist to some level. But if I were thinking about forecasting basis, further, say, like you said, into next spring, early summer, I would probably revert back to the blue line as being, at least that's what the research would suggest. The blue line would be a better forecast than trying to incorporate the current premium. And there's a lot of things that go into that, time value and things like that. But really, that would be the suggestion would be to kind of revert to the blue line. That's the recommendation that we make.
And if that's the case, then storage hedging in that environment doesn't look real attractive, does it?
Yeah, well, I mean, again, the future side of the storage hedge is a disaster to begin with, and then the basis shows you there's not a lot of basis improvement, and so at that point, it really storing unhedged soybeans is really the only reason that you would store it at all, right? Is to speculate that futures and basis are going to give you something going there out into next year.
So we probably should throw the caveat in there and say, well, if you're going to store some, why are you doing it? And there's probably really maybe a couple of reasons why. One is what's going to happen in South America, right? That's always the hope, I suppose, of U.S. farmers, is that there's a shortfall in production in South America, which would give us a boost. And obviously there's been some discussion recently about dryness in South America, so that speculation has already started, I suppose.
Yep.
But that is very speculative at this point. And then the other one, of course, would be just whatever happens with respect to exports and relations with China, and whether or not we wind up seeing stronger exports than what the market is currently anticipating. But I think your point, Michael, is that speculating on both of those things is somewhat risky, right?
Yeah.
Particularly when you're foregoing what appears to be a very profitable opportunity to market this significant portion of this 2020 crop, right?
Yeah.
Okay. So that kind of leads into your next slide, Michael.
And it seems to me, I just want to ask one question of you guys. It seems to me that it's somewhat rare to have a year where one crop is really short and the other one is not so short. You go back to 12, and we were looking at both corn and soybeans are relatively tight. So I think that creates some opportunities to to do some more sophisticated marketing with your corn and selling the soybeans.
I would agree with that. With respect to marketing, I think the opportunity to earn storage returns, and people have asked us this for the last few weeks. My bias has been to store corn as opposed to devoting storage space to soybeans. I think many farmers would be well served to market a significant portion of their soybeans at these kind of prices, particularly the combination of strong futures and strong basis is the kind of thing you hope for at harvest time, right?
Yeah.
So I think that's the way I would look at it. And then as you think about what's going to take place over the course of the spring and summer, there's still some opportunity for some basis improvement. And so on the corn side, you have some opportunities there. But so with that, Michael, let's take a look at the income forecast.
Yeah, we've been updating this chart the last several months. And back in July, we were looking at net farm income per acre. This is assuming a corn soybean rotation, right at 0. In fact, we were comparing it to 17 and maybe even getting as low as that triangle in 2015 in the negative range. Oh, how things change. Increase in prices, the second round of CFAP payments, and we're looking at a projected net farm income for this West Central Indiana case farm at right at $100. What's not included in net farm income? Obviously, if there's some unpaid family and operator labor, that would need to come out of there. And so if that's $30 to $40, that would still leave us, $50, $60 of income that we could use to repay debt and also perhaps buy some machinery. In fact, if you look at these numbers here and compare them over time, we're looking at the strongest net farm income since 2013. And so maybe this is the year where some people take a little closer look at buying some machinery that's worn out in the last several years.
Yeah, to put this in perspective, I was thinking about this chart that we've updated, I think, pretty much every webinar. And it was just a few months ago, and we were talking about 2020 being a year that was maybe the worst and actually coming close to being about the same as 2015.
Yes.
This is a dramatic turnaround in a short span of time, right?
Yeah.
So
makes you pretty humble in your projections. This is just a little different way of looking at it from a profit margin standpoint. Again, the profit margin in 2020 is expected to be the highest since 2013 if the prices we talked about earlier are bore out. And so 2021 is not looking real good right now. I do have some small government payments in 2021, but it's really hard to predict what those are going to be. And so I did want to say that I think I have $10 per acre built into the 2021 numbers. And they likely aren't going to be very big because it's probably not going to get a very good payment for soybeans. And then corn is, we looked at that price earlier, it's $3.60. That's not a very big PLC payment. And so 2021 does not look as good. But let's focus on 2020 here. Again, I think this is a year where we start to build back some of that working capital we've lost and maybe take a look at buying some machinery.
yeah, I guess I'm going to maybe take a little bit of an issue with you on your last statement there, right? Given the erosion in working capital that's taken place the last 5 years, probably the first thing to do on many farms is to rebuild working capital.
And of course, we've talked about that before. It really depends on where a farm is at. I mean, there's a rather substantial group percentage of farms. It's at least 25%, probably closer to 50%, depending on how you define tight working capital, where they just need to build working capital. But you do have some folks out there that have some pretty good working capital, even coming into this year. That's the folks you're probably going to see take a little closer look at purchasing machinery.
Yeah. Well, I'd add to that too. I mean, from a strategy perspective, Michael, given the drastic shift we've seen in a short period of time, it'd probably be prudent for a lot of folks to just sit down and reevaluate where they are this year and maybe where they want to be in the next 3 to 5 years. Because that drastic change is going to change a lot of things for people.
Yeah, and definitely start crunching some budgets for 2021, because if 2021 does turn out to what we're looking at right here, you need to save some of that working capital that you've built this year to offset the losses in 2021.
Yeah, good point.
We look at this pretty much every month, at least we have for the last several months, difference in earnings per acre. So this is using full costing, and we're looking at corn and soybeans for a case farm in Indiana. And 2020, no big surprise there with a large increase in soybeans, that soybeans are considerably more profitable than corn. There's some people out there wishing they'd have planted more soybeans compared to corn, probably in particular in the western corn belt. In the eastern corn belt, in Indiana in particular, we did plant more soybeans than corn, so some people are smiling about that. And that's gotten larger. We were talking about that earlier, Jim. That's at least twice as big as what it was a month or two ago because of the soybean prices have increased faster than corn prices here in the last few weeks. I want to focus on 2021. It's kind of a toss-up right now when you look at the budgets for corn and soybeans. It looks like there's similar profitability for both corn and soybeans, and so pay close attention to that corn to soybean ratio or soybean to corn ratio as we move closer to planting.
Yeah, for clarity there, when you did your projections for 21, you're looking at futures for the 21 crop.
November 21 soybeans and December 21 corn.
And those futures are not currently anticipating the tightness that we're currently experiencing continuing into the 2021 crop year.
A pretty large difference between soybean futures this fall and what they look like in the fall of 21. It's not pennies. It's substantially larger than that. And again, what they're expecting, no big surprise there. If soybean prices remain relatively strong, I think the market's anticipating that we'll see a bump in soybean acreage.
So we get lots of questions, emails and otherwise, about cash rent, and you've taken a look at that as well.
We've been talking about downward pressure the last several months. I think we can throw that out the window. Downward pressure in 2020 cash rents has evaporated, is the way that Jim and I, stayed here in the title of the slide, and that's because the 2020 cash rent is very close, or the net return to land is very close to the cash rent. This is with full costing, and so there just isn't that much pressure for 2021 cash rents to decline.
Yeah, so that gap has narrowed. I mean, this is another slide that has changed dramatically.
It's even bigger than my net farm income. We were looking at $100 net return to land in June or July. I forget whether it was June or July or both. In fact, I think we were even a little lower than $100, and so now it's $150 per acre increase in net return to land.
Yeah, so our earlier suggestions about downward pressure on cash rent were based on that large gap between the cash rent line on that chart and the bar for net return to land, and that has evaporated.
I want to talk about the other side because some people might be looking at this chart and say, well, maybe we're going to see an increase in cash rent. So that leads me to my next slide. I think it's a little premature to be looking at increases in cash rent in 2021 and 2022. This is a very complicated slide, so let me talk a little bit about it so everybody understands what I'm trying to do here. I've got land price in relationship to net return to land and land price in relationship to cash rent. So the blue line is land price in relationship to cash rent. Cash rent with a 5-year average, looking at a little longer than 1 year. We've got land price in relationship to net return to land, also using 5-year averages, so we get a little longer perspective on what's going on here. And the fact that the red line, the land price to net return, is higher than the land price to cash rent suggests that we still don't have very much upward pressure on cash rents looking at next year and 2 years from now, because if you look at the 5-year, what it's essentially saying, when you look at the 5-year average of net return to land, it's still quite a bit lower than the 5-year average of cash rent.
Yeah, good point. So some of those cash rent discussions took place this summer. They're continuing to go on here this fall. The tenor of that discussion has changed pretty dramatically in the last 2 months, maybe the last 3 months, right?
And we were talking about flex rents earlier. They're certainly not for everybody because they're considerably more complicated than both share rent and cash rent. But this is not a bad year to be thinking about that. If there's a pop in revenue next year for whatever reason, you can take advantage of that as a landowner with a flex rent.
I think actually the volatility that we've experienced these last 3 months is a good argument for flex
Yes.
rent arrangements, right?
Yes, definitely.
Yeah. All right, that kind of wraps up our discussion. And so I just want to remind everybody the Purdue Top Farmer Conference is still coming up. That's in January 8th of 2021. More details will be available as the fall progresses, but if you don't have that on your calendar, I hope you put it on there, and we'll make some of the details and speakers and the outline of the program available a little bit later, but put that on your calendar.
Can they register for that yet?
They can. That's on the website as of today. So.
And I would encourage them to do so.
Yeah, thank you for reminding us.
Sooner rather than later.
All right, thanks for joining us today. On behalf of the Center for Commercial Agriculture and my colleagues, I want to say thank you. I'm Jim Mintert.